Ladies and gentlemen, there's this man called Dhruv Rathee. Many of you might already be knowing him. He has been a very, very vocal critic of the BJP-led national government at Delhi. Last week, he put out a tweet in which he provided some figures according to which India's national debt has grown by more than 4 times over the last 10 years that the BJP has been in power. He's implicitly trying to suggest that over these 10 years, India's national debt has completely spiraled out of control. But is that really the case? Ladies and gentlemen, I'm going to examine this issue through the lens of this piece of financial innovation, which to begin with is completely neutral when it comes to political affiliations. And secondly, it comes closest to serving the role of a crystal ball through which we can gaze into the future. And this piece of financial innovation is called the stock market. And we are going to look at this issue through the lens of the stock market because it's the stock market which has historically been always the first to spot the dangers and flag the dangers whenever the national debt of any country has started to spiral completely out of control and the future growth potential of that country is not sufficient to support a timely and orderly repayment of that debt. And if you want examples of that, there's no better example than the most indebted country on the face of this planet, Japan. Ladies and gentlemen, this is how Japan's primary stock market index has shaped up over the last 40 years. The Nikkei 225 index witnessed a lifetime high of about 38,900 points on 29th December 1989. This is a level that this index will not see for next 34 years. Just imagine somebody who invested in 1989 will not see any growth in his portfolio for the next 34 years. This is what debt does to your economy and to your stock market index. Do you want to see what's happening with the next Japan in making when it comes to the size of the debt pile? This is how the Shanghai Composite Index has shaped up over the last 15-20 years. It witnessed its lifetime high of about 6,100 points in October of 2007, just before the global financial crisis of 2008. And then this index crashed by a whopping 70% during the course of 2008. But that's not extraordinary because almost every stock market index around the world crashed by a similar order during the course of 2008. What is extraordinary, though, ladies and gentlemen, is that since that bottom of 2008, Shanghai has not even doubled. That translates to a measly growth of just 3.8% per annum over the last 15 years. And what is even more remarkable is that even today, Shanghai is more than 50% lower than the all-time high witnessed back in October 2007, more than 16 years back. Ladies and gentlemen, this is what debt does to your economy and to your markets. Now, do you want to see how the true showstopper of this fashion parade looks like? And this is what happens when national debt is not a problem. Ladies and gentlemen, the real showstopper looks like this. And all of us here in India have a lot to be proud about because this is none other than our Nifty 50 index. The Nifty also witnessed its lifetime high in January of 2008, and then the Nifty crashed by a whopping 60% during the course of 2008. This 60% crash is not very different from the 70% crash witnessed in Shanghai. That's where the similarities end, ladies and gentlemen, because since that bottom of January of 2008, the Nifty has rallied a staggering 9 times over the last 15 years. That translates to an annualized return of over 15% per annum. Ladies and gentlemen, India's national debt is not a problem. I wish I could have said the same thing about this guy. Hi, my name is Indraanil Guha and I'm one of the co-founders of MetaCaps.ai, which is India's first and probably only personal finance platform where we run hedge fund strategies driven almost entirely based on global macros. Ladies and gentlemen, once again, I cannot start this video without thanking each and every one of you for the kind of love and support that you all showed to my last video. As I record this video, my last video has managed to get more than 30,000 views. More than 2,000 of you were kind enough to subscribe to my channel after watching my last video. Ladies and gentlemen, mine is still a very, very young channel. I started my content creation journey just about 6 months back. And my last video was only the 16th video that I shared on my channel. So it's absolutely overwhelming to see this kind of support so early on in my content creation journey. Ladies and gentlemen, I promise this kind of love and support can only inspire me to work harder still so that I can continue to bring very high quality content to you all going forward as well. Now coming to the topic that I want to discuss in this particular video. Ladies and gentlemen, last week my business partner in one of the businesses that I run forwarded to me a tweet of this guy called Dhruv Rathee. Dhruv Rathee is of course a very, very vocal critic of the present BJP-led national government at Delhi. And in this particular tweet, Dhruv Rathee was essentially trying to suggest that over the last 10 years that the BJP has been in power, India's national debt has been spiraling completely out of control. And my business partner wanted me to do a video to counter this particular tweet of Dhruv Rathee. And my instinctive response to my business partner was that, I don't discuss politics on my channel and that my channel is dedicated solely for the purpose of discussing economy and markets. And the reason, ladies and gentlemen, I don't like discussing politics on my channel is not because I don't have a political opinion or I don't have political inclinations. I do. But I choose to keep it to myself or at best discuss the same with only friends and family. Because the harsh reality, ladies and gentlemen, is that we live in such politically charged times where if you open your mouth and you end up saying anything that is deemed as against the government's agenda, then you are immediately labeled as somebody who is part of the so-called liberal gang. And if you end up saying anything that is supportive of the government's agenda, then you are immediately labeled as somebody who is probably part of the BJP's IT cell. And that's why, ladies and gentlemen, I believe it's almost impossible in today's times to discuss politics objectively, at least on a public forum. And that's why I choose to discuss on topics that are related to my areas of strength, which is essentially markets and economy. This is where my business partner tried to step in once again and tried to stress to me that Dhruv Rathee's tweet deserves to be countered not because of the underlying politics, but because of the impact of the issue that he is trying to raise on our markets and economy. And that's when it hit me, ladies and gentlemen, that even if inadvertently, Dhruv Rathee has ended up raising an issue which, if true, is likely to have a pivotal impact on our markets and economy in the coming years. Because let's face it, ladies and gentlemen, if indeed our national debt is spiraling out of control, then India's growth story is over for good. Because history is very clear on this. Whenever the national debt of any country starts to spiral out of control, initially it can be stimulative for the national economy for some time. But it always ends up very, very badly. Because out of control growth in national debt invariably ends up becoming a very, very big drag on the growth potential of both the economy as well as the markets. And that's why, ladies and gentlemen, it's critical for us to understand if indeed our national debt is spiraling out of control or not. Because if it is, it's not going to impact Dhruv Rathee because he's sitting in Germany and it's probably covered by their social security. But it's going to impact you and me because we are sitting here in India and our fortunes are tied very, very closely to our markets and our economy. And it's going to impact us irrespective of whether we vote for the BJP or the Congress or any other party. And that's why, ladies and gentlemen, it's absolutely critical that we examine whether our national debt is growing uncontrollably or not. And it's critical that we discuss Dhruv Rathee's threadbare. Now, the first and the most obvious problem with Dhruv Rathee's argument is that he's looking at the amount of our national debt in isolation. And it's meaningless to look at the amount of national debt in isolation because when it comes to debt, be it the debt of a country or be it the debt of an individual, debt must always be looked at relative to the entity's income. Because it's the income that determines whether the amount of debt that the entity has is excessive or not. Let's say, for example, 10 years back in 2014, let's say you had an income of 1 lakh rupees per month. And at that time, you decided to buy a house and for that you took a home loan of 35 lakh rupees. And on this home loan, let's say you were paying an EMI of 31,500 rupees back then. Over the next 10 years, since then, let's say your income has gone up by 3.5 times and your current income stands at 3.5 lakh rupees per month. And in tandem with the growth in your income, you have also decided to upgrade your lifestyle and move into a larger house for which you have taken a larger loan. Let's say you have taken a loan of 1 crore rupees and on this 1 crore rupee home loan, you are currently paying an EMI of, let's say 90,000 rupees. Now, on the face of it, the amount of debt that you have currently, 1 crore rupees, is significantly higher than the amount of debt that you had 10 years back. In fact, the amount of debt that you have right now is almost 3 times higher than the amount of debt that you had 10 years back. But is that really a problem? Clearly, that's not a problem, because in tandem with your debt, your income has also gone up. In fact, your income has gone up at a faster pace compared to the rate at which your debt has gone up. 10 years back, relative to your income, the amount of EMI that you were paying was only 32% of your total income back then. Compared to that, the amount of EMI that you are paying towards your home loan right now is 90,000 rupees. That's significantly higher than the amount of home loan EMI that you are paying 10 years back. But this higher EMI represents a lower share of your income today. This 90,000 rupees represents only 26% of your income right now. So relative to your income, your debt has in fact come down. And that's why, ladies and gentlemen, when it comes to debt, you must look at debt relative to income. And it's the same principle that we need to apply to national debt as well. When it comes to national debt, we must look at debt to GDP ratio, not the absolute level of national debt in isolation. And when you look at debt in terms of debt to GDP ratio, this is the picture that emerges for India's central government debt relative to India's GDP since 2003-2004. And as we can see, since 2003-2004, India's central government debt to GDP has steadily fallen from 67% all the way down to about 50% in 2018-2019. After that, of course, we started to see a big jump in India's central government debt to GDP. But as you might have guessed, this big jump in central government debt to GDP was because of the onset of the COVID pandemic, because of which there was a double whammy for India's national debt. On the revenue side, there was a big setback for tax collection, because personal incomes and corporate profitability both dropped very, very dramatically because of the lockdowns, and as a result, government's tax collection suffered very, very badly. This is on the revenue side. And on the expenditure side, of course, expenses of the government went through the roof, because the government was forced to roll out a number of very, very expensive programs in order to support our citizens who were adversely impacted by the COVID pandemic, especially those who are at the bottom of the pyramid. But ladies and gentlemen, it's also worth noting that as the COVID situation has started to normalize, India's central government debt to GDP ratio has once again started to fall and currently stands at 58%, which is significantly lower than the 67% central government debt to GDP ratio that we had about 20 years back. Now, of course, when it comes to the total debt to GDP of the country, we also need to factor in the debt of the state governments. And when you add the debt of the state governments, this is how the total central and state government debt relative to GDP looks like since 2003-2004. And when you add the central state government debt, clearly the picture becomes a little more murky, because especially over this last 10-year period, state government debt relative to GDP seems to have gone up at a faster pace compared to central government debt relative to GDP. Well, ladies and gentlemen, can you really hold the central government responsible if some of the state governments have not been very prudent fiscally and have chosen to grow their debt in a very out of control fashion? Well, in my opinion, you cannot really hold the central government directly responsible for a disproportionate increase in state government debt. But having said that, even if after factoring in this slightly faster pace of state government debt relative to GDP over the last 10 years, the overall broader picture still doesn't change. 20 years back, India's total debt to GDP used to be about 85% of our GDP. That steadily fell to about 67% by 2010-11. And then it remained within a very narrow range between 67% and about 70% all the way till about 2018-19. After that, of course, we saw a steep jump in total state and central government debt relative to GDP because of the onset of the COVID pandemic, because because both state and central governments had to roll out very, very expensive programs in order to support the citizens during the COVID pandemic. But once again, when it comes to total central and state government debt relative to GDP, we have seen a steady decrease in the level of debt once the COVID situation started to normalize. And as you can see, the current cumulative central and state government debt relative to GDP stands at about 82%. Now, this 82% total government, national government debt to GDP, is that supposed to be a very high level of debt to GDP or not? For that, we need to compare this to the debt to GDP ratio of other leading economies in the world. And when you do that, this is how the picture looks like. These are the top 50 countries around the world in the descending order of their total national debt to GDP as of 2022. As you can see, the topper in this list is Japan with a debt to GDP ratio of a staggering 250% plus. Where is India on this list? With 82% debt to GDP, India is at rank 42 on this list, way behind some of the most developed economies in the world, such as Japan, United States, United Kingdom. So India is very low in this ranking of the most indebted countries in the world relative to their GDP. So clearly, even by global standards, India's debt to GDP cannot be said to be very high. If you really want to understand the true impact of rising debt levels on the economy and markets of a country, then you need to dig deeper. You need to look beyond just the debt to GDP ratio of a country. Because not every category of debt is the same. Not every category of debt has the same impact on a country's economy and markets. Usually, rising debt levels are never really a good thing for the long-term prospects of any economy or any markets. Having said that, there are certain categories of debt which can do good to the economy and markets of countries over the long term. And that's why it's really important to understand the true nature of the debt concern. And it is in this context that we need to understand two key characteristics of the national debt. The first characteristic that you need to understand is the currency of the debt, whether the debt of that country has been raised in its own local currency or the debt has been raised in a foreign currency. Usually in case of developed countries such as US, countries in the Eurozone, Japan, for these kind of countries, usually most of the debt is usually in their own local currency. The debt can be from a foreign entity, but the debt will be denominated in the local currency. So for example, in case of the US, there are large amounts of US government debt which is held by the Japanese government and the Chinese government. So it's the Chinese and the Japanese who have lent this amount of money to the US government. But the money, even though it has come from a foreign entity, the debt is denominated in US dollar. So for the US, the debt is still in its own local currency. But that's usually not the case in case of developing countries, especially developing countries from Africa, because most of these poor developing African countries have to borrow from international funding institutions such as the IMF and the World Bank, and most of the loans extended by these international funding institutions are typically denominated in US dollars. So in case of these loans, the loans are typically in a foreign currency. Now, what is the implication for a country based on whether the loan is in its own local currency or whether the loan is in a foreign currency? Well, the implications are very, very grave. Because if the loan is in your local currency, then you are in a very, very comfortable zone. Technically, if the loan is in your local currency, then technically you can never default. Because even in the worst case scenario, if you run out of money, you don't have money to repay your lenders, you can always print money and return the money to your lenders. Well, it's a different story that if you indiscriminately print money, then you are going to devalue your own currency. That's a separate problem. But you will never default on your loans as long as the loan is in your local currency. So this is an extraordinary privilege enjoyed by developed countries whose debt is usually in their own currency. But this is a privilege that usually developing countries don't have, because in their case, most of the debt is usually denominated in a foreign currency, typically in US dollars. So in case of developing countries, if they run out of money and they are not able to repay their lenders, then they will not be able to print US dollars to repay their lenders. So in that case, you will end up in a default situation if the borrower is not able to return the money to the lenders. The second characteristic of the debt that we need to understand is what is the use case of the debt? What is the debt used for? Now, there's any number of ways you can spend the money that you have raised through the debt, but I broadly categorize the use case in three buckets. Firstly, you can spend the debt by way of monetizing government deficits. I know that sounds like a lot of jargon, but just bear with me. I'm going to explain that to you in very simple language in just a while. The second use case of debt, as I see it, is putting money into the hands of people so that they can spend. The third use case is creation of productive infrastructure. So these are the three broad categories in which you can spend the money that you have raised through debt. Now, based on these three use cases of debt and the two currencies, local currency versus foreign currency, in which you can raise the debt, you get this nice 3x2 matrix that you see on the screen right now. What is a 3x2 matrix? Basically, you get these 6 buckets in which the national debt of any country can be categorized into. And based on in which category the national debt of a country best fits into, the implications for the economy and the markets of that country can vary very, very significant. So let's understand what are these 6 categories of national debt and what are the implications for national economies and markets in the case of these 6 categories of national debt. So I'll start by taking up the first 2 categories together, because both these 2 categories of national debt relates to debt taken by developing countries in Africa, Asia, and Latin America. And these are loans which are typically taken from external agencies or foreign countries and are denominated in a foreign currency, usually in US dollars. And 3 prime examples of countries which have gotten into trouble in recent times because of this category of debt are Zimbabwe, Sri Lanka, and Pakistan. All these 3 countries have been in news recently because all the 3 have had very severe debt crises because of this category of loans. So let's understand why is it that these countries got into trouble. So let's start by examining what's the national debt to GDP ratio of these 3 countries. So this is what I have presented here on this chart. You can see the national debt to GDP of these 3 countries. I have also added India's national debt to GDP on this chart, although India hasn't had debt crisis in recent times, thankfully. But I've added India to this list so that you can compare how does the national debt to GDP ratio of these 3 countries compare to that of India. And one thing that you can hopefully see is that the national debt to GDP ratio in itself for these 3 countries is not very significantly different from India's. In fact, in case of Pakistan, the national debt to GDP ratio is lower than that of India. And even in case of Zimbabwe and Sri Lanka, where the national debt to GDP ratio is higher than India, it's not as if that it's outlandishly higher than that of India. And yet, except for India, all the 3 countries on this list have had very serious debt crises, but India hasn't had one. So why is it that there is such a stark difference, although the national debt to GDP ratios are of a similar order? And this is why I say it's important that we understand the characteristic of the debt, because not every debt is the same. Not every kind of debt is going to have the same impact on the national economy and on markets. The real reason why these countries got into trouble was not because of the sheer size of the national debt, it was the source of the national debt. All these 3 countries have a very high share of external debt. As you can see, in case of India, the external debt to GDP ratio currently is only 18.6%, which is very, very low, very, very manageable. In case of Pakistan, it's 37.2%, twice that of India. Zimbabwe is still higher, 48.4%. And Sri Lanka, 74, almost 75%. That's completely out of the charts. So it's because of this very high share of external debt that these 3 countries got into trouble. All the 3 had a debt crisis. So what is it about external debt that gets developing countries into trouble? Now, there are two broad categories of loans that are taken by developing countries. The first category of loans are what are called development loans. These are loans which are extended by international funding institutions such as the World Bank and the International Monetary Fund or the IMF. These are usually subsidized low interest loans which are reserved for the very poor countries. And then there is a second category of loans which are increasingly being taken by a large number of developing countries. These are called infrastructure loans, and China is a very, very big player in this segment. Lately, a large number of developing countries have gone to China and borrowed heavily from China to invest in large infrastructure projects in their countries. And Pakistan and Sri Lanka are two prime examples of countries which have borrowed very heavily from China to invest in infrastructure projects in their respective countries. Now, what is the difference between the loans that are extended by the likes of IMF and World Bank and the loans that are extended by China? Firstly, the first difference is interest rate. The interest rate charged by IMF and World Bank usually tends to be very, very low. The interest on the loans given by these two organizations tend to be in the range of 1 to 2% per year. Also, the duration of the loans extended by the likes of IMF and World Bank tends to be very long, about 25 to 30 years. And the intent of World Bank and IMF is to basically make it easier for the borrowing country to repay back the loan. As opposed to this, the loans extended by China tend to carry a much higher interest rate. These are loans which carry an interest rate of 5, 6, 7%, at times even higher than that. Also, the duration of these loans which are extended by China tends to be much shorter. The duration tends to be in the range of 10 to 15 years. The combination of high interest rate and shorter duration ultimately makes it that much more difficult for the borrowing country to be able to repay back the loan. But what gets these countries really into trouble is when the projects for which they have borrowed from China turn out to be unviable. So, for example, in case of Sri Lanka, it borrowed almost $1 billion from China to build this massive port in southern Sri Lanka called the Hambantota port. But once the construction of this port was complete and this port became operational, it turned out that there is hardly any traffic at the port. And since there was not enough traffic at the port was not able to generate sufficient revenues to be able to repay the loan that the Sri Lankan government had taken to build this port. And this is what ultimately pushes countries like Sri Lanka into a debt crisis. And this is what has happened across multiple projects in Pakistan and Sri Lanka. Now, be it development loans or infrastructure loans, when the time comes for you to repay your loan, but you don't have the money to repay the loan, you obviously get into a very, very tricky situation. Because there's a deadline to repay the loan, but you don't have the money to repay the loan. And if you're not able to repay the loan on time, then you get into something called debt default. And if you default on your loan, then nobody is going to lend you money in the future. And that's why a default is something that every government in the world wants to avoid at all costs. And that's why if a government comes on the verge of defaulting on its repayment obligations, then governments invariably end up resorting to very, very desperate measures. What are these desperate measures? Your lenders have lent you money in US dollars, but you don't have the US dollars to repay your lenders, right? But as a government, you have a monopoly over printing your own currency. And there exists an international forex market where there is a exchange rate that prevails between your currency and the US dollars. When you are on the verge of defaulting on your loan, you would be tempted to attempt printing of your own currency in the hope that you will be able to exchange these newly created local currency notes for US dollars in order to repay your lenders. That is never going to work, because the moment you start indiscriminate money printing in order to repay your lenders, you're essentially devaluing your own currency. You are robbing your currency of its purchasing power. And the moment indiscriminate money printing starts, international forex markets take immediate notice of that. And since you are devaluing the value of your currency, the prevailing exchange rate between your currency and US dollars will not sustain any longer. The exchange rate will very, very quickly start to collapse. And this is exactly what has been happening for last many, many years in case of currencies of Zimbabwe, Pakistan, and Sri Lanka. So, for example, in case of Zimbabwe, this is how the exchange rate of the Zimbabwean dollar has shaped up against US dollar over the last 10 years. As you can see, about 10 years back, around 2015, you could still exchange one US dollar for a couple of hundred Zimbabwean dollars. But since then, the exchange rate has completely collapsed. As of now, you can exchange $1 for more than 30,000 Zimbabwean dollars. So the Zimbabwean dollar has lost more than 99% of its value. It has become virtually worthless. Something similar has happened with the Pakistani rupee also. Although the scale of the devaluation may not be as large as in the case of the Zimbabwean dollar, but nevertheless, the scale of devaluation is still quite remarkable. As you can see, back in 2017, the exchange rate of the Pakistani rupee against the US dollar used to be 1:103. That is, against $1 you could exchange 103 Pakistani rupee. Since then, the Pakistani rupee has collapsed and has lost 2/3 of its value. The current exchange rate is $1 for 278 Pakistani rupee. Now just imagine, when your currency loses 2/3 of its value, what does it do to domestic prices? Let's understand this through the price of oil. Back in 2017, the international price of crude oil used to be about $50 per barrel. I'm talking about Brent crude. And at that time, as I just mentioned, the exchange rate between US dollar and Pakistani rupee used to be $1 would be equivalent to about 103 Pakistani rupee. So in terms of Pakistani rupee, one barrel of crude oil would cost about 5,000 Pakistani rupee. What is the price of one barrel of crude oil in Pakistani rupee now? The current price of crude oil in dollars is about $89 per barrel. And the current exchange rate is $1 is equivalent to 278 Pakistani rupee, which basically means that in Pakistani rupee terms, one barrel of crude oil now costs almost 25,000 Pakistani rupee. So the price of crude oil in Pakistani rupee terms has gone up by 5 times over the last 7 years. Now just compare this to the situation in India. I am based in Mumbai and I drive a diesel car. Back in 2017, the cost of diesel in Mumbai was around 60 rupees, probably a little less than that. Today it's about 95 rupees. So prices have gone up in India also, but price increase is of the order of about 50-60%. In case of Pakistan, the prices have gone up by 5 times. Just imagine what it does to the overall price level when oil price in local currency terms goes up by 5 times. Oil prices feed into the prices of everything because you need oil to transport everything. And that is why inflation level starts to spiral completely out of control in these kind of countries when you get into a debt crisis. And that's how you get headlines like this. In case of Zimbabwe, last year they experienced a inflation level of 175% per year. In case of Pakistan, the inflation levels are around 37% per year. Here in India, the current inflation level is about 5%, but the highest inflation level that we have witnessed over the last since COVID is about 7.8%. That's the highest inflation that we saw. Now, many of us here in India crib about our inflation levels being high. Just imagine how much worse it can get if we get into a Pakistani or a Sri Lanka kind of a situation. And mind you, I'm talking about countries which are in our immediate neighborhood. So this is what very high national debt, especially very high external debt, does to your economy, does to your inflation levels, does to your exchange rate. Now to summarize, whenever developing countries end up taking excessive amounts of loans, especially in foreign currency, and eventually they are unable to repay that loan, that can lead to a state of hyperinflation in case of these economies. Now moving on to the next category of debt. This debt is usually taken in the local currency of the borrowing country and is used for monetizing government debt. Now this category of national debt is exclusive to developed countries such as United States, Japan, countries in the Eurozone, to a certain extent even middle income countries like China. Now before I proceed, I want to explain what exactly is monetization of government debt. Now every government has to impose taxes to cover its expenses. But taxes are usually never enough to cover all expenses. There is always a shortfall. And this shortfall is what is called government's fiscal deficit. Fiscal deficit is nothing but the difference between government's expenditure and government's tax revenues. How is this shortfall covered? To cover this shortfall, the government has to borrow. How does the government borrow? When you and I have to borrow, we go to a bank, we take a loan. Government doesn't typically go to a bank to take a loan. Instead, the government sells what are called government bonds. And anyone who invests in these government bonds essentially is giving a loan to the government. So that's how the government borrows, by selling government bonds. Now, there are times when the amount of money that the government needs to borrow is very, very large. This happens especially during times of recessions, when the amount of money that the government needs to borrow becomes very, very excessive, because these are times when the government has to roll out a number of support programs for its citizens and businesses in order to provide them relief in the middle of a recession. So during such times, the government has to borrow extraordinarily large sums of money. And during such times, it can so happen that the number of investors that are available in the government bond market are not sufficient to be able to provide the government with the amount of money that it needs to borrow. And during such times, the central bank of the country has to step in to help the government. What is the central bank of a country? The central bank of a country is the entity which is responsible for printing money. In case of India, the Reserve Bank of India is our central bank. In case of US, the Federal Reserve Bank is the central bank of the United States. These are the two entities which print money in our two respective countries. And during times when the amount of money that the government needs to borrow becomes so excessive that the number of investors available in the government bond market are not sufficient to be able to provide the requisite amount of money, the central banks of the country have to step in, and the role of the central bank during such times is to simply print all the money that the government needs during such times and provide this money to the government. So in effect, what happens during such times is that the government sells bonds equivalent to the amount that it wants to raise from the government bond market, and all this money is printed by the central bank, and the central bank buys all these bonds from the government and pays the money to the government. So the government gets the amount of money that it needs from the central bank. What is the difference between the government selling government bonds to people like you and me versus government selling government bond to the central bank? Well, when the government sells government bonds to you and me, the total amount of cash in the economy, cash in the financial system remains the same. There is merely an exchange of cash from the investor to the government. We pay whatever existing money, the money that already exists in the financial system, that is already there with us, we pay that money to the government and buy the government bond. However, when the government is selling government bonds to the central bank, the central bank is creating new money, is printing new money into existence, and with this new money, central bank is buying the government bonds. So in the process, the total amount of cash in the financial system, in the economy, goes up when the government is selling government bond to the central bank. And this phenomena whereby the government sells bonds to the central bank and the central bank prints new money to provide funding to the government so that the government can cover its fiscal deficit, this phenomena in technical terms is called monetization of government debt. So what are some of the examples of monetization of deficit? The most prominent example of monetization of deficit in recent times was the subprime crisis of 2008 that was witnessed in the United States. What was the subprime crisis? The origins of the subprime crisis go back to around 2003-2004. That was around the time the US government rolled out a program which was intended to promote home ownership rates amongst lower income families. So banks were given incentives to extend lower cost subsidized loans to lower income families. So banks started to participate in this program and started extending subsidized loans to lower income families, which helped a lot of lower income families to buy houses for the first time. And as a lot of lower income families started to buy houses, housing demand started to go up, and as a result, housing prices also started to go up. And as housing prices started to go up, it started to attract many more investors to come and invest in real estate projects because they also wanted to participate in this budding rally that was kicking in. And as even more people came into the housing market to invest in real estate projects, that bumped up prices even further. And at some point in time, it became a self-fulfilling loop, and it kept on attracting ever increasing number of people to participate in this loop. More and more people started to come in, and as more and more people started to come in, prices started to go up even further. And once it gets into this self-fulfilling loop, at some point in time, this kind of a rally starts to acquire the characteristics of a bubble. And the point where it especially acquires the characteristic of a bubble is when the banks stop doing the necessary due diligence while giving out the loan. So banks stop doing the necessary assessment of creditworthiness of the borrower at the time of giving out loans to the people who come to the bank to borrow for investing in the real estate projects. Because complacency seeps in into the banking system, banks start to assume that real estate prices will keep going up forever, and as a result, the creditworthiness of the borrower doesn't matter, because banks assume that even if some of the borrowers default on their repayment obligations, they always have the option to go and repossess the house and then sell off that house at a profit, and in the process they will very easily be able to recover their exposure on that property. Now this assumption is correct as long as defaults are few and far between. As long as there are few defaults once in a while, banks will be able to go and repossess the house, sell off that property and recover their exposure to the house. But if very large number of loans are given to people who are not creditworthy, who should not have been given the loans, who do not have the capacity to repay the loans, then at some point in time, there will be a big spike in delinquency. There will be a big spike in defaults. So you won't have defaults happening in isolation. You will have defaults happening en masse. And when large number of people, large number of borrowers start to default all at the same time, and banks have to repossess a large number of houses at the same time and put them up for sale in the housing market at the same time, then it can lead to a situation of oversupply in the housing market. And if there is an oversupply in the housing market, house prices will stop going up any further. In fact, beyond a point, if defaults keep on mounting even after that, then house prices can actually start to fall. And that's exactly what happened from 2007 onwards. Default rates started to increase so much that banks had to repossess these houses, and there was a glut of oversupply in the housing market. And as a result, initially house prices stopped going up, and from 2008 onwards, house prices actually started to crash freely. Eventually, at the end of 2008, we had a situation where large number of US banks were sitting on huge piles of bad loans, bad home loans that they had extended to people who should not have been extended these loans. And on these loans, the borrowers had basically defaulted. In this kind of a situation, how do you tackle the situation? Now, the US government and the Federal Reserve, the central bank of the US, had two options. First option was you can let free market capitalism work its way through, punish the banks for the sin of not doing the necessary due diligence and lending indiscriminately without adhering to banking standards, which would have almost certainly meant that vast majority of the banks in the US banking system would have collapsed and would have gone bankrupt. But large-scale bankruptcies in the banking system would also mean that the overall stability of the economy would have been compromised. This is something that had happened in the dark days of the Great Depression of 1929. It's a very, very painful experience. And if an economy descends into a depression, then the 1929 experience shows us that it can take the economy not just years, but decades to come out of that depression. So the Federal Reserve and the US government decided another novel approach, which is monetization of the deficit. As part of that monetization of deficit program, what the Federal Reserve did was it printed a humongous amount of money. Basically, between 2009 and early 2015, over a 6-year period, the Federal Reserve ended up printing almost $3.5 trillion. The Fed's balance sheet size went up from about $1 trillion all the way up to $4.5 trillion. So balance sheet going up from $1 trillion to $4.5 trillion basically means that the Fed printed about $3.5 trillion during this 6-year period. And what was this newly created money used for? This newly created money was largely used for buying out these bad debt from the commercial banks and clean up their balance sheet. So the Fed either directly bought these bad loans from the commercial banks, or it gave money to the US government so that the US government could bail out these banks. But the intent was to take out these bad loans from the balance sheets of these commercial banks, so that the balance sheet of these commercial banks are cleaned up and all these bad loans are transferred to the balance sheet of the Federal Reserve. And once the balance sheet of these banks are cleaned up, they can make a fresh start, they can start lending afresh, and they can start making profits afresh. And the idea was, once the banks start making profits all over again, they can then start to repay back the Federal Reserve slowly over a long period of time for the losses that were incurred on the subprime loans that were extended in the run-up to the subprime crisis of 2008. What the Federal Reserve was able to achieve by way of this program of monetizing the deficits is to spread the pain of the subprime crisis, subprime losses over a very long period of time. And in the process, it made the pain of the subprime losses a lot more bearable. And what the Federal Reserve was also able to achieve was, it was able to avoid very large-scale bankruptcies in the banking sector of the sort that was witnessed during the 1929 Great Depression. And to that extent, this approach of monetizing the deficits, this approach can be called quite a bit of success. But having said that, the Federal Reserve was not the one which invented this approach of monetization of deficits. This approach was actually pioneered by the Japanese central bank in the early 1990s. So they pioneered this approach in the aftermath of the 1989 bursting of the Japanese real estate bubble. So the Japanese also had a huge real estate bubble in the late 80s, which finally burst around 1989. And following the bursting of the real estate bubble, there was a very large crash in real estate prices in Japan. There was a very large correction in the Japanese stock market also. And in the aftermath of that, the Japanese central bank stepped in. It started printing a lot of yen. And with all these newly created yens, the Japanese central bank bailed out most of the Japanese commercial banks, which would have otherwise collapsed. So we had a very similar program along the lines of what was seen later on in the US happen back in the 1990s in Japan also. And finally, in case of China also, a very similar deficit monetization program has been at play for a very, very long time. Now, in case of China, during the 1980s, 90s and the early 2000s, these were the boom years for Chinese growth. During this time, a lot of infrastructure got built, a lot of new roads, a lot of new railways, a lot of new airports got built. Now, the thing with infrastructure is that initially when you build infrastructure in a country where there is no infrastructure, that leads to humongous improvement in efficiencies, because when you build good roads, build railways, build airports, you help move people and goods faster from point A to point B. There is less wastage of goods and perishables, and as a result, there is a significant improvement in the overall efficiency levels of the economy. And as a result, these initial infrastructure projects tend to be very, very viable. They are very easily able to generate sufficient returns so that the repayment of the debt can be very efficiently be done in a very timely manner. However, once the requisite amount of infrastructure has already been built, if you keep building infrastructure even after that point in time, then that can be quite wasteful. So for example, if let's say a city already has 2 airports and both these airports are operating at only 50-60% capacity, then it doesn't make sense to build a third airport for this city, because chances are that this airport will operate at a still lower capacity. And if the airport operates at a very low capacity, then it won't be able to generate sufficient revenues to be able to repay back the loan that is taken to build the airport. So it will turn out to be a wasteful infrastructure project that is unviable. However, China kept on building such wasteful infrastructure projects anyways, even after the required amount of infrastructure had already been built. Why? Because the Chinese government has this peculiar system. The central government every year allocates growth targets to the provincial governments. And how can the provincial governments meet this growth target? The easiest way for the provincial government is to go on a building spree, go and build infrastructure projects, build new roads, build new railways, build new airports. Doesn't matter whether that airport is required or not. At least in that in that particular year in which the airport or road is built, in that year, the construction of the road will create economic activity, and that leads to a boost, at least temporarily, for that particular year for the economy. It doesn't matter even if later on that project turns out to be unviable and the loan taken for building that project turns out to be a bad loan. That's not a headache for the provincial government. That's a headache for the banks. And that's how the Chinese provincial governments have ended up building a lot of wasteful infrastructure, especially after 2008. So in the process, there was a huge pileup of infrastructure related bad loans in the banking system. And as if this was not bad enough, since the onset of the COVID pandemic, even the real estate bubble has now burst in China. So right through the decade of 2010s, there was a huge frenzy in the Chinese real estate sector. A lot of builders came into the market, they launched projects, and a lot of households got attracted to the housing sector. A lot of families invested in houses. House prices kept on going up. So, and that in turn attracted even more buyers to come and invest in real estate projects. And households invested in the hope that prices will keep going up and they will be able to sell this property to somebody else at a higher price. The intent was never to go and use that house for residential purpose. The intent was just to speculate on the housing prices. And this frenzy kept on going on and on and on. But finally, with the onset of the COVID pandemic, this party finally came to an end. After the COVID pandemic, there was a remarkable slowdown in real estate demand. And because of this slowdown, a large number of very large real estate companies in China, which to begin with were highly leveraged, they started to go bankrupt. The most prominent amongst these was this company called Evergrande, which was probably the world's largest real estate company. It finally went bankrupt a couple of years back. And as these large real estate companies started to go bankrupt, they left behind large real estate projects unfinished. So a lot of home buyers were saddled with houses in projects which were not complete. What was the end result? The end result was banks were saddled with a lot of bad loans because of these property projects which were left unfinished. What is the final result? The Chinese banking system was saddled with a humongous pile of bad loans related to the infrastructure sector as well as the real estate sector. The end result, the same thing that happened in US and Japan. The Chinese central bank had to step in, monetize all this debt, print a lot of money in order to bail the Chinese banks. Now you must be wondering, isn't there any downside for these developed countries when they indulge in such large-scale monetization of deficit, when the central banks print so much amount of money in order to bail out the banks? Because we earlier saw that in case of developing countries, when they indulge in large-scale money printing in order to repay their lenders, immediately they get hyperinflationary situation. So isn't it the same case when similar money printing happens in case of developed countries? Well, curiously, the answer is no. In case of developed countries, when they print money for the purpose of deficit monetization, you do not get inflation. Now, this is very, very counterintuitive, and the reason why they don't get inflation is quite complex, but I'll try to explain this anyway. So you need to understand, how do you get inflation? If the central bank prints money, and this money goes out into the real economy, it goes out into circulation, it lands up in people's bank accounts, then people are going to use this money to spend on goods and services. If people get new money into their account, then people will go to malls and spend that money. People will go to restaurants and spend that money. People will go and buy new cars with that, and they will spend this money on a whole bunch of goods and services. And when people spend real money on goods and services, that pushes up demand for goods and services, and that's how prices of goods and services go up, and that's how you get inflation, when money printing leads to amount of money in circulation going up. But you need to understand, in case of deficit monetization that happens in case of developed countries, the new money that is created, it doesn't really go out into the real economy. It doesn't go out into circulation as such. This money remains within the banking system. It remains within the financial sector. The newly printed money is merely given by the central banks to the banks which have incurred huge losses on their loan portfolio. So the money goes from the central banks to the commercial banks to compensate them for the losses. And mind you, these commercial banks over time have to return this money also to the central bank over a period of time. So this money remains isolated within the banking system. It doesn't go out into circulation. And as a result, this money doesn't get spent on goods and services. And that's how deficit monetization doesn't lead to inflation. Now you must be thinking that it's almost like a free lunch for these developed countries. The central banks of these developed countries can print as much money as they want. Whenever there's a banking crisis, they can bail out their banks with the newly created money, and it's not as if that there's going to be any downside in the form of very high inflation either. So they really get to have the best of both worlds. But ladies and gentlemen, it's only partially true. Yes, we have to accept that in case of developed countries, they can print money and monetize the deficits to bail out their banks whenever there is a banking crisis, and that will not result in very significant inflation. And that in itself is a very extraordinary privilege that the developed countries have, something that developing countries don't enjoy. But that's not to say that there is no downside or cost that is incurred by developed countries when they indulge in large-scale monetization of deficit. There is a cost to pay, because try to understand it this way. When a country indulges in deficit monetization, it's not as if the banking sector has been completely left off the hook. The banks, when the central bank does deficit monetization, the commercial banks are given a second chance. They get to make a fresh start. Their balance sheet is cleaned up, and they can start making fresh loans, and they can start making profits afresh. But they also have to, once they start making profits afresh, these commercial banks also have to repay back the central bank gradually over a period of time for the losses that were incurred on the bad loans that were extended during the bubble period. And these repayments over a period of time can be a big drag on the growth potential of these banks. I'll try to explain that with an analogy. Just think about a person who has invested in a real estate project. Let's say this person has bought a property worth 1.2 crores, and for buying this property, he has taken a home loan of 1 crore from a bank. When this person takes a home loan of about 1 crore from a bank, the monthly EMI will come to about 90,000 rupees. Now, as per the payment schedule of the builder, let's say this person has also paid the builder almost 90-95% of what is due to be paid from his side. But for whatever reason, the builder could not complete the project, and before completing the project, the builder went bankrupt. As a result, this gentleman is now saddled with a real estate property which is not complete, but he is also saddled with a home loan worth 1 crore on which he has to keep paying an EMI of about 90,000 rupees for the next 20 years. And against this home loan liability, he doesn't have any asset. In fact, he has a dead asset. This is an asset in which he cannot move into because the house is not complete, and he cannot even sell off this house because nobody will buy an incomplete property. Now just imagine what is going to happen to this person over a period of time. Let's say this person has a monthly income of 2 lakh rupees. And let's say he manages to his monthly expenses are within 1 lakh rupees per month. So this person is generating a surplus of 1 lakh rupees every month. Now, in a scenario where this person did not have this home loan liability, this entire 1 lakh rupee surplus that he is generating could have been invested in productive assets such as mutual funds, ETFs, and direct stocks, which could have potentially generated a return of 10, 11, 12% per annum over the next 20 years. That could have resulted in significant amount of wealth creation for this person. However, in the scenario that the predicament that faces this gentleman, he will not be able to invest this entire 1 lakh surplus that he is generating. Instead, bulk of this surplus is going to go towards servicing the home loan that he has taken. So 90,000 out of the 1 lakh surplus he is generating would go towards servicing the home loan, and only 10,000 rupees is left after servicing the home loan. This is what can be invested in the productive investments such as mutual fund, ETFs, and direct stocks. So since the amount of money that he's being able to invest in productive assets has come down so significantly because of his repayment obligations to the bank, his final net worth at the end of 20 years would be significantly lower than the scenario in which this home loan liability would not have been there. And this is exactly the predicament that is faced by the banks of countries where large-scale deficit monetization happens. Because of the repayments that the banks have to do for the bad loans that they had given out during the bubble years, this becomes a big drag on the long-term profitability of these banks, on the long-term growth potential of these banks. And when there is a slow growth in the banking sector, that becomes a drag for the entire economy at large. And that's why after the real estate bubble burst in Japan in 1989, and after the Japanese central bank had to start doing deficit monetization, for 10 years after that, there was no GDP growth in Japan. And this period was labeled by economists as the lost decade. But what started out as the lost decade eventually turned out to be lost 3 decades, because there were 30 consecutive years of zero economic growth, zero GDP growth in Japan. That's how painful deficit monetization turned out to be for Japan. And guess what? It's the stock market which has historically been very, very efficient in detecting the onset of such a slowdown in the growth potential of a country well in advance. Just see how the Japanese stock market has shaped up since the bursting of the real estate bubble in 1989. As you can see, the Japanese stock market, the Nikkei 225 index, it peaked in December of 1989. The peak was 38,916 points. In the immediate aftermath of the bursting of the real estate bubble, we got almost a 60% correction in the Japanese stock market index. Now, this 60% correction in itself is not very extraordinary. After every big shock, stock markets tend to correct very, very steeply. But if there are no risks of a long term, of a slowdown over the long term, stock markets recover also very, very quickly. So, for example, in case of India, there was a 60% correction in the NIFTY in 2008 in the aftermath of the subprime crisis. But very quickly, within a matter of 2 to 3 years, the Nifty rebounded fully and was back to the pre-crash peaks. But that didn't happen in case of Japan. After the initial 60% correction, even after that, the market continued to be within a narrow band. And after some time, it once again started to correct even further. By 2003, it was down to about 7,800 points. After 2003, it recovered a little bit. And finally, once again, during the course of the subprime crisis, it crashed to an all-time low of about 7,200 points. So by 2009, the markets finally bottomed. So for 20 long years after the bursting of the real estate bubble, the Japanese index continued to go down. And by 2009, the index was down more than 80% compared to the peak witnessed in December of 1989. Just imagine how painful this period would have been for Japanese investors. For 20 years to see negative return of 80%. It's only after 2009 that the Japanese index finally managed to see some recovery. But it took the Japanese stock market another 15-16 years to finally get back to the level that was last witnessed in December of 1989. For 34 years, the stock market had not witnessed the levels that were witnessed in December of 1989. Just imagine someone who invested in the Japanese index in December 1989. This person would have seen zero return for 34 years. What can be worse than this? This is what happens to your economy and to your stock markets when you do large-scale deficit monetization. And if you think this is bad, you need to wait and see what is happening with the Chinese stock market. This is absolutely the next Japan in making. The Shanghai Composite Index peaked in October of 2007, before the global financial crisis of 2008. The peak was about 6,100 points. And in the immediate aftermath of the crash of 2008, the markets corrected by more than 70% and came down to almost 1,700 points. So this was almost a 71-72% kind of a correction. Now, this in itself is not very extraordinary because during the course of 2008, almost every market around the world corrected by 60 to 70%. So this correction, the scale of the correction was obviously very steep, but this in itself is not very extraordinary. What is extraordinary is the measly returns that the Chinese stock market has produced since that bottom of 2008. Since November 2008, the Shanghai Composite Index has not even doubled till now, which basically means that the annualized growth rate that this index has produced over the last 15 years has been just 3.8% per annum. And even today, the Shanghai Composite Index is more than 50% below the level that was below the peak that was witnessed in October of 2007. So even though the Chinese growth rate officially did not start to slow down all the way till the onset of the COVID pandemic, the stock market had detected the impending onset of this slowdown almost 10 years in advance, back in 2008 itself. Since then, the stock market has started producing very poor returns, which was basically indicative of the impending onset of a slowdown in the Chinese growth rate. So that's why I say that the stock market is always a very, very efficient predictor of the onset of a slowdown in the economy caused by deficit monetization. So to summarize, in case of developed economies, if the national governments of these countries borrow from their central banks and in the process they monetize their deficits, that in itself doesn't cause inflation. And that, to be honest, that's an extraordinary privilege that these developed countries have. But even though there is no inflation as a result of deficit monetization, we have still seen that most of these countries who indulge in deficit monetization over a period of time witness their long-term growth slowing down very, very significantly, as we have clearly seen in case of Japan and China. Now moving on to the next category of national debt, and this category of national debt again relates to the debt of developed economies. This is the debt that is taken in the country's own local currency, and this debt is used for putting money into the hands of people. And the most glaring example of this was something that was witnessed in the United States in the aftermath of the COVID pandemic. Let's understand what happened in US in the aftermath of the COVID pandemic. So I've shown you this chart a little while back. This is the chart which shows the Fed's balance sheet size over the last 15 years. We saw that the Fed printed almost $3.5 trillion in the aftermath of the subprime crisis from 2009 all the way till 2015. And during this round of money printing, most of this money was used for deficit monetization, basically to bail out the banks which had suffered huge losses in the aftermath of the subprime crisis. But since most of this money remained within the banking system, within the financial sector, was used primarily to bail out the banks, this money did not go out into the real economy, into circulation. There was no inflation as such in the US economy as a result of all this money printing. And this made American policymakers and politicians very, very ambitious. The second time large-scale money printing happened in the US was in the aftermath of the COVID pandemic. This time round, the Fed printed even larger amounts of money than was done in the first round of money printing after 2008. Post-COVID, the Fed's balance sheet size went up from $4 trillion all the way to $9 trillion. So almost $5 trillion worth of new money was created. But this time round, it didn't stop at just money printing. This time round, the politicians and policymakers became even more ambitious. Since there was no inflation in the first round of money printing that happened between 2008 and 2009 and 2015, a lot of policymakers and academics started to believe that US is a special case, and no matter how much money you print, it will never result in inflation. So this time round, a lot of politicians came up with very, very ambitious policies. In fact, one of the key policies of the Biden administration was to provide direct cash transfers to American citizens who had lost their job as a result of the COVID pandemic. So a large number of American citizens who were impacted because of the COVID pandemic and were sitting at home receive large sums of relief from the US government directly into their bank accounts. Now imagine what will happen when you receive money into your bank account. And these cash transfers were happening at a time when the supply condition was severely constrained. Most of the goods that are sold in America come from China. And factories in China during the COVID pandemic were operating at significantly below full capacity because of the lockdowns that were imposed by the Chinese government. So goods were not getting produced in adequate quantities, and whatever little was getting produced, not all of it was reaching American shelves in time because ports were operating at far below full capacity. So the supply condition was very, very severely compromised. And in such a constrained supply condition, in the middle of that, American government starts to put money into people's hand, and you are stoking demand. So on the demand side, you are putting demand on fire, and supply is severely constrained. That's a textbook case for stoking inflation. And did we get inflation? Boy, we got record inflation. This red line represents how the inflation levels in US has shaped up over the last 10 years. As you can see, for the better part of last 10 years, this red line has hovered around the 2% level, which is where the inflation levels of US has been for the better part of last 10 years. And then COVID happened, all the money printing happened, and a lot of this money was put in people's bank account. As a result, inflation went to a 40-year high of 9.1%. So this shattered all myths that if you do money printing, it won't cause inflation in case of special countries like US. There is no such thing as US being a special case, and COVID proved this conclusively. In fact, inflation is something based on which I personally decide whether a country should be called a developed country or a developing country, because developed countries usually have historically had very low inflation levels in the range of about 1 to 2%. As you can see, US has had inflation in the range of 1 to 2% for the better part of last 10 years. It's developing countries like India which tend to have higher levels of inflation around 5 to 6% level. This blue line represents the inflation levels of India over the last 10 years. And as you can see, India's inflation levels has hovered in the range of 5 to 6%, 4 to 6%. And for the better part of this period, US inflation levels have always remained significantly lower than India inflation. But this changed during COVID. As you can see, during COVID, the red line, US inflation level, decisively went above India inflation level and remained higher than India inflation level significantly for a very long period of time. During COVID, in fact, India's peak inflation level was only 7.8%, whereas US's peak inflation level went all the way up to 9.1%. So this conclusively proved that irrespective of whether you are a developed country or a developing country, if you put money in the hands of people, you will get inflation. So this is the summary. It doesn't matter whether you are a developed country or a developing country. There is no such thing as US being an exception. The laws of economics will catch up. If you put money in the hands of people, it will cause inflation. And this is what we got in the aftermath of the COVID pandemic. Now coming to the most important bucket of this framework, I'm going to take up the last two buckets together. These two buckets represent the scenarios where the national debt is used for creating productive infrastructure. The operative word here is productive infrastructure, the kind of infrastructure that is actually required for the growth of the economy, not the kind of wasteful over expenditure on infrastructure that is probably underway in China right now. Now, as for examples of the countries which fit into this bucket, India very, very clearly fits into this bucket because there's a massive infrastructure push underway in India right now. There's a very strong focus of the current government on creating infrastructure. China was also very clearly in this bucket until very, very recently. But in my opinion, by 2008, China had almost built out almost all the necessary infrastructure across the country. And since then, most of the infrastructure that's being built in China, in my opinion, is kind of unnecessary over expenditure on infrastructure that is being done just for the sake of generating GDP growth by the local provincial governments. Now, coming to the details of India's infrastructure push, some of the numbers emerging out of the budget papers are simply startling. So, for example, the total allocation to infrastructure in the budget of financial year 23-24 has gone up to 10 lakh crores. That represents 3.3% of the GDP. You don't even have to go back 10 years to the Congress years, even compared to just 5 years back, compared to 2019, this allocation represents a 3 times increase. Ministry of Railways is emerging as one of the key areas of focus. The government has allocated 2.4 lakh crores to the Ministry of Railways in this year's budget. This is the highest ever allocation to railways and represents a 9 times increase over the allocation to railways back in 2013, 2014. A lot of the railway now requires a lot more money because we are investing in projects like bullet train and all, which are very, very capital intensive. Last but not least, Ministry of Road Transport and Highways, this continues to be the focus. The highest allocation within infrastructure continues to be to this ministry. The allocation to this ministry has now gone up to 2.7 lakh crores. That's up 36% over the last 1 year. So why is spending on productive infrastructure important for countries like India? If you think about it, India has traditionally been infrastructure starved. And in any infrastructure starved country, once you start building high quality roads, railways, airports, you instantly bring about improvement in efficiency levels for the overall economy. Why? Because good quality road infrastructure, railway infrastructure, airport infrastructure, that facilitates faster movement of people from point A to point B. You are able to move goods faster from point A to point B. Since you are able to move goods faster, there is less wastage, especially in case of perishables. So since you are able to move goods and people faster and there is less wastage, over time inflation levels start to come down. And as inflation levels start to come down, interest rates also start to come down. Now, lower interest rates are extremely stimulative for growth. So as interest rate levels start to come down, growth level get a further boost over the long term. And if you think about it, all these factors are now at play in case of India. So how can we be sure that our infrastructure spending is on the right path and that our infrastructure spending is not spilling over into wasteful, unnecessary pieces of infrastructure? I think the best way to be sure about that is to keep track of inflation levels. As long as inflation continues to remain stable, still better, as long as inflation is coming down, we can be sure that efficiencies because of infrastructure spends are continuing to accrue to the economy. And as long as that is happening, we can be reasonably sure that our infrastructure spending is on the right path. The other indicator that can sort of confirm to us that our infrastructure spending continues to be on the right path and that our growth path is still very, very bullish is our stock market, because we have seen in case of Japan and China, as and when a slowdown in the national growth rate is about to kick in, the stock market has been very, very reliable in terms of picking up those signals and flagging the possibility of a growth slowdown in the form of subpar returns kicking in the stock market too. But that's not the case with our stock markets right now. This is the Nifty 50 over the last 20 years. If you look at the Nifty's recent trajectory, it's painting a very, very bullish picture for India's future. So Nifty's pre-2008 crash peak was about 6,300 points, and then Nifty corrected by a massive 60%. Nifty came down to about 2,500 points. In terms of the scale of the correction, India's 60% correction is of the same order as the 70% correction that was witnessed in the Shanghai Composite Index. So both these indices corrected by a very, very similar order back in 2008. But this is where the similarities end, because since 2008, it's been 15 years and yet the Shanghai Composite Index has not even fully doubled. And the annualized growth rate that this index has delivered since that bottom of 2008 is a measly 3.8% per annum. And what is really scary is that even today, Shanghai is more than 50% below the peak witnessed before the 2008 crash. Now compare this to what's happening with our Nifty. Since the bottom of November 2008, the Nifty has rallied a massive 9 times. So in terms of annualized growth, the Nifty has delivered 15% per annum growth since the market bottom of November 2008. In case of Shanghai, its current level is still 50% below the pre-2008 peak. In case of Nifty, the current level is about 22,500 and the pre-2008 peak was about 6,300. So compared to the pre-2008 peak, the Nifty is more than 3.5 times above that level. Compare that to China. China is even today 50% lower than the pre-2008 peak. So two very starkly different pictures being painted about the growth prospects of these two economies by their two respective stock markets. So to summarize, as soon as countries like India start to invest on high quality infrastructure, the efficiency level for the economy as a whole starts to go up, because you're able to move people from point A to point B faster. You're able to move goods from point A to point B faster when there's lesser wastage in the process of transporting people and goods. And as a result, inflation starts to fall over time. As inflation starts to fall over time, interest rates start to come down. And low interest rates are always very, very stimulative for growth. So long-term growth prospects get a very solid boost. Now, to summarize this overall framework, this is what I really want to stress. Of all the buckets, there is only one bucket where rising national debt has a very positive outcome. In case of all the other buckets, all the buckets that you see here, irrespective of whether you are a developing country or a developed country, the outcome of high national debt is always negative. Only in case of this bucket is the outcome of high national debt kind of positive. Now, I'm not even trying to suggest that India will permanently be in this bucket forever. At some point in time, even our growth rates will start to peak, just as China's growth rate has now decisively peaked. But that date is still some time away. And till then, India will continue to present one of the best investment opportunities anywhere in the world. And this is something that no Indian investor should lose sight of. Not least because the likes of Dhruv Rathee are needlessly trying to paint a very, very negative picture about India's growth prospects. Ladies and gentlemen, this brings me to the end of this rather long video. I hope I was able to add some value to you by way of the content that I presented in this video. I thank you very much for watching this video. If you like the content that I have presented in this video, please do like and share this video, and please do consider subscribing to my channel. Thank you very much.